Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 23rd December 2022, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Director of MUFG's Global Customer Marketing Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Derek. Great to have you here as we head into the festive break.
Indeed. Thanks, Simon. And you?
Thank you. The markets, they seem to be quietening down now for end of year holiday period. I guess the award for the final shock of the year will have to go to the BoJ after this week's policy announcement. So what implications do you think that decision will have on BoJ policy going forward and the yen in particular?
Yeah, no, absolutely. It was definitely the surprise element. I did speak about this in the podcast last week, and I said clearly we didn't think it would happen. Although the reasoning we gave was primarily about just the fact that Governor Kuroda was coming to the end of his term and that he would probably hold out until a new governor took over. But I also kind of highlighted that there were the fundamentals that were beginning to stack up in favor of some steps being taken. Now, bizarrely, in my view, Kuroda didn't seem to want to go there at all in his communications this week. It was very much a technical decision. It was about the functioning of the JGB market and improving that functioning rather than anything related to a fundamental change warranting a move. And I think that lacked credibility, to be honest. And the market reaction showed that, certainly initially, with the 10-year JGB yield yesterday close to tipping the top of the new band at 0.5%. It's dropped back a bit today. So I think certainly the other elements of the announcements in terms of just the widening of the band was obviously perceived as a step towards normalization. But there was also the announcements of additional JGB purchases next year from 7.3 to 9 trillion. And then unlimited purchase programs would continue as well next year and would be conducted across the whole yield curve. And I think part of the problem was this distortion in the yield curve that the BoJ wants to reflect by buying not just the 10-year, but other tenors as well. So, we could be in a situation next year where the BoJ is actually expanding its balance sheet because of yield curve control. And that's obviously going to be in pretty sharp contrast to much of the rest of G10, which is going to be conducting quantitative tightening. So, net, you could argue that's yen negative, but I think the bigger picture is going to remain the driver of the yen. And that bigger picture, of course, is that I do think this is the first step towards a normalization process. And the only question is, how long does that process take? And at the moment, our view is that the next step would ultimately be undertaken by the new leader of the BoJ. And they would likely launch a policy review and then take a couple of meetings perhaps to do that, and then give an update beyond that. And I would imagine it could be either something removing the 0% commitment and just having a wider range, something that kind of broadens out the flexibility. I think that would be the next step. I don't think they would fully abandon YCC as a first step. So to answer your question, Simon, I think the yen is still going to be supported by the view that what happened this year and the sell-off being policy divergence driven mainly, although the energy shock, of course, was very important in weakening the yen as well. But that next year, that's going to reverse, where you've got the Fed pausing, we think, at the end of the first quarter. The markets are still priced by about 50 basis points of easing by the end of next year. And we're going to have a new governor undertaking a shift in policy in Japan, and that all points to lower dollar yen. And, interestingly, this week, the drop on the day of the announcement was over 4% on the day. That's the biggest one-day drop in dollar yen since October 1998. And those who were in the markets then would remember that we had this unprecedented drop over a 3-day period from 134 to 111. And that followed surprise cuts from the Fed because of the Asian financial crisis contagion risks. Now, the drop that we've had this week obviously wasn't on the Fed, it was on the BoJ, but the similarity with 1998 is the fact that the BoJ were intervening to buy the yen in the months before the move in 1998, just like now. And I think that the key point there is that, when you've had yen buying intervention and then the fundamentals do turn, you can have very rapid moves to the downside. And I'm not convinced that's over yet. So when we plug in our values for what we think could be what unfolds in US Treasury yields, in JGB yields, you get to 125, we think, as an equilibrium level. And of course, the danger is you could undershoot just like we overshot on the upside. So yeah, I think dollar yen lower is still likely, and I don't think the move that has begun has finished. And it's really about the timelines on the BoJ leadership. We should start to get information in February. Historically, that's when it becomes known to the markets. And there's two candidates: the current deputy governor, Masayoshi Amamiya, and then the former deputy governor, Hiroshi Nakaso. There was a Bloomberg survey recently on the options between those two, and the current deputy governor, Masayoshi Amamiya, is the favourite to take over. That would be continuity, but I still think the markets would expect change as we go forward.
Thank you, Derek. And aside from the BoJ and yen, then, what do you think the markets will be focusing on when we get back in January?
Well, interestingly, I mentioned there about the fact that the curve in the US is still showing 50 basis points of easing in the second half. 40 basis points of easing in the second half of next year. And, as we get into Q1, that suddenly then doesn't become too far away. And I just don't think something has to give. I think, and it could happen relatively quickly. It's either the Fed's hawkishness and concerns about the speed in which inflation comes down means the curve starts to reverse that easing and it takes it out of the curve, or we start to get data that confirms that, and the Fed are going to have to pull back. I think initially it might be a bit of the former, where the easing, some of the easing could be taken out of the markets. Like, I'm not convinced the labour market's going to just roll over in January, February time. And that tends to be, certainly from a euro-dollar perspective, a seasonal bias favouring dollar strength. And given the dollar weakness we had in October, and in particular in November, which has been maintained through December, I still have a bias towards the dollar recovering some in January, February. And if the data doesn't roll over, and in particular the labour market data and the wage data, I think the investors are going to start doubting the conviction of rate cuts towards the end of next year. Now, ironically, we do think that will materialize, but I think something gives in January, February, and it could be that the markets reconsider the Fed's quick pivot to cutting rates. And that means risk aversion, that means equity markets lower, and that means increased volatility. But we're certainly more leaning towards the scope for the dollar recovering in the first part of next year. The data this week was interesting in terms of consumer confidence was stronger than expected. The labour market elements were positive. And that, to me, tells you the labour market isn't about to roll over. So even if inflation's becoming better and is drifting lower, if the wage data doesn't follow, then the market's idea of cutting is likely to be wrong.
Well, finally, I just wanted to focus on your trade ideas. So how have your trade ideas performed this year, and what are you thinking specifically as we move into 2023?
Yeah, no, we had a profitable year. So, we've been running trade ideas in our FX Weekly since 2019, when we started in mid 2019, I think. So that 2019 was a loss. I put that down to learning and getting some experience in terms of how you do that. But basically after that, we've had profitable years in 2020, 2021, and now again in 2022. So all pretty positive. In terms of this year, the standout profitable trades, we had cable. So we caught the cable move when we had the debt crisis and the Truss quasi-Kwarteng growth plan, which of course was a disaster. And we shorted cable on going into that. So I think our stop was hit our profit take stop was hit, within 2 trading days, I think. So we caught that move. And then the other kind of very profitable trade was long Swiss franc, short Turkish lira. And again, there we caught in May the pretty sharp depreciation of the lira. The energy price surge was taking place. Inflation was really ramping up. But the central bank in Turkey were holding the line and were refusing to raise rates. And of course, then they started to cut rates. And that really saw a big adjustment in lira during that period of time. So we caught that move as well. So those were the kind of standouts. Long Aussie CAD towards the end of the year as well. Well, in November, that was another profitable trade. So yeah, we had another good year. I think going into next year, we had a short Aussie yen position, which we cut out for flat. That was the last trade of the year. Unfortunately, we should have kept that, obviously, given what happened this week. And Aussie yen has dropped pretty notably across, including all the other yen crosses. We'd probably look to what I just said earlier. We'd probably look to position for long yen, whether that maybe not against the dollar, given we think the dollar will rebound, but possibly Aussie yen is still got more to go on the downside. So we may look at some kind of position to capture a further strengthening of the Japanese yen. If not, then obviously something just dollar positive related, given we think the dollar could recover some in January, February.
Well, thank you very much and have a wonderful festive break.
And you, Simon. Thank you.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.